Welcome everybody to episode 9 of the Crash Course here at V2 Trade. We're almost done, just one more episode after this. Today we will be discussing risk management and we'll be overviewing the topics of risk to reward and the ratio and also the importance of this alongside additional facts. So let's get straight into this. This episode will be quite quick because although risk management is very important, it's very simple. So let's talk about what a risk to reward ratio is. So risk to reward ratio is essentially on a single trade, how much you will win compared to how much you will lose. For example, if you have a trade where you're looking to take a short, but your loss if you lose a trade is much bigger than your win if you win the trade, that's not good in a risk management standpoint. Let's take through an example of a real potential trade that shows and demonstrates this. Okay, so on this trade, we will lose $1,500. 1,500. Yeah, the amount is 1,500. And on the bottom, the amount is 2,679. Essentially, what this is showing is that for every dollar you put in, you expect to get $1.36 back. This is a pretty good risk to reward ratio. But something like this is not good because this essentially says that for every dollar you put in, you expect to get 0.5 back. To make something like this sustainable, you're going to need a ridiculously high win rate, and that's probably going to be over 70-80% even. So tying all this together, your win rate should match with your risk to reward ratio because you want your risk to reward ratio to be at least at a 1-to-1, and that's a rule of thumb. The rule of thumb is to leave your risk to reward ratios at least 1-to-1, because if it's something like this, you can be profitable if you win only 50% of the time. Now, if your risk to reward goes down, say let's go to 2. On TradingView it says 2, but that's the same as 1 to 2. It's all the same. You always look at this number divided by this number. So this would equal 2. For every dollar we put in, we expect to get $2 out. If we win the trade, we win $2. If we lose a trade, we lose $1. This is how individuals can be successful in the long term because they have great risk management tools and rules set up in place for them to succeed. So if we have a 2 RR ratio, or a 1-to-2 risk to reward, then you only need you can win with having less than 50% win rate. Let me do some quick calculations and tell you the exact number. Okay, so if you have this, to be profitable or to break even, you need a win rate that is greater than 1/3. So you need to win 1 in every 3 trades in order to be break even. So if you win more than 33% of your trades, you will be profitable with the risk to reward ratio of this. So this truly highlights how the importance of matching your win rate with risk to reward is essential, and essentially you're battling against your risk to reward to get to a certain win percentage in order for you to be profitable. So let's take a look into the importance. Essentially, if your win rate does not beat your risk to reward in the long run, like we said, you cannot be profitable. So it's important that you change and adapt to the market in order to ensure that your win rate and risk to reward does stay sustainable. This can be the boring side of trading where you're looking over specific numbers, but this is very essential in order to succeed. Individuals should set up risk management rules such as a daily loss threshold and how many losses they can take before they end the day. To give an example of this, you could say that an individual would want to lose $300 before they end the day, or individual after they've taken 2 losing trades, they end the day. Something of that sort. Additionally, there should be sizing rules. If you're risking a certain amount of ticks, as it would be in the futures, because that is the measurement of movement on futures, maybe sizing rule would be that if it's over 100 ticks, you size down to half your normal position size. You need to have all of this set up in place. You need to know what your normal position size is. You need to know what your size down position size is. And if you're scaling in, you need to know your scale in lots as well. Furthermore, you should also know how much to risk on a day-to-day basis. Typically with prop firms, you can go up to like 5 to 10% risk every single day. But if you're trading on a live account and if you truly want to be sustainable without the worry of trying to get something so quickly, this is a battle in the long run. So for long-term success, it is most preferred to risk 2 to 3% max a day, with the maximum threshold being 5% a day. But typically you want to risk 2 to 3% a day max and hope to gain 4 to 5, maybe even 6% a day on your winning days. So if you set up your days and set up important rules like this when it comes to risk management, you can be profitable even if your win rate is not that great. But just remember, it's a battle between you, your win rate, and your risk to reward. So that's it for this video. What we've talked about today was we talked about the risk to reward ratio and the importance of it. We've talked about some rules that are essential to set up in order for you to succeed and truly keep yourself accountable. And also we've discussed the importance of risk management and taking a look at numbers and statistics regarding your performance as well. This is essential in order to adapt, evolve, and stay sustainable as a trader. Thank you so much, and I'll see you guys tomorrow. If you have any questions, leave a comment down below or join the Discord and ask me a question. Link is in the description. Goodbye.